Okay, we're going to go ahead and get started. Good afternoon. Welcome to the Minnesota webinar, Understanding Self-Employment Tax for Independent Contractors, Sole Proprietors, and Single-Member LLCs. And Kristin will be our presenter, and I will turn it over to her in just a moment. My name is Doug DiVirgilio. I'm a member of the Education Committee and one of our mentors here at Minnesota SCORE. And just some information about SCORE before we start. So here's how you can request a mentor. In fact, that slide is not the one I want to be on. Where's this other slide? I'm at the end. Hold on, let me get to the beginning. There we go. All right, so what is SCORE? SCORE is a nationwide organization that partners with the SBA. We have 10,000 volunteers who are business professionals, some still employed, others retired, who volunteer their time to work with small business of America, mentoring at no cost to you. In Minnesota, we have 90 volunteers, and that is serving Minnesota, Sarasota and Manatee counties. And you see there on the slide, it does not include Northport. Our chapter recently has been recognized as District Chapter of the Year. And since it was founded in 1964, SCORE has assisted over 11 million clients and small businesses throughout the U.S. Now, how can we help you? Well, there's a lot of ways we can help you. Many we help in pre-startup. They're dreaming about a business they want to start. They want to shift out of. They've been thinking about for a long time. The research and planning can be intense. We've got a lot of resources we can share with you. I encourage you to go to our website, which I'll talk about in a minute. It's loaded with great information for you, both podcasts, webinars, download documents, and an ability to request mentors. If you're in a startup phase, opening your business, if you're in business and you're experiencing a lot of growth, we've actually seen clients struggle. How do I manage this growth? Where do I find good employees? Or if you're thinking about buying, selling, or closing your business, we can also be of a lot of assistance to you there. Now, how do you access this? Visit score.org/Minnesota. You can view mentor profiles. You can request a direct mentor, have one-on-one mentoring available to you. It also shows our workshops, our recorded webinars. There is a YouTube channel we have. I would encourage you to go look at. It's Minnesota YouTube, and it's got all the recorded webinars, including this one when we're done. Now, just FYI, each of you will receive, probably later today, a copy of the slides Kristin will go through and the recorded webinar. So you'll all get that. It'll also be available on our YouTube channel. We do ask that all of you ask your questions as you have them. Kristin would like to have you ask them as you have them. Please put them in Q&A, and we'll address them as they come up. I want to thank our sponsors. Without them, we wouldn't be able to be here. Here you see a list. Again, many of them are financial. So a lot of our clients need financial access to capital and access to loans. And so it helps if you're working with one of our mentors reaching out for that. And with that, I'm going to stop my screen share and turn it over to Kristin.
Thank you. Thanks, Doug. All righty, we're going to get moving here because everybody is in a time crunch, and particularly this time of year. And Doug, can you see my screen? We're all good?
Yes, we're all good, Kristin. Looks good.
Okay. Awesome. So today we're going to be talking about self-employment tax and estimated payments for solopreneurs, independent contractors, and single-member LLCs. So who am I? I'm Kristin Delfo, EA. EA actually stands for Enrolled Agent. What is an enrolled agent? We are federally licensed in tax by IRS to do what we do. We are able to represent clients not only in tax prep, but all the way through appeals, not including tax court. For that, you would need an attorney or someone with a very, very specific designation that is not an attorney. But we are like cousins of CPAs, if you will. IRS is really bad at marketing and presenting what an enrolled agent is. So that's why I'm sharing this with you. I'm a tax professional. I'm a financial mentor. Is just really my mission is to teach step-by-step shame-free solutions to bigger money questions like taxes, insurance, and investing, and all in plain English. You'll get to experience some of that today. Hopefully you find it in plain English. I've been doing this for almost 20 years now, and I've had my own practice since 2008. And then I started Her Money Solutions to teach financial literacy back in 2021. So today we're going to talk about, there's a bunch of different taxes that happen on small businesses, and depending on the state that you're in can influence this as well. Everybody knows about income tax. This is the tax that's paid on your net income. This is, generally speaking, your gross income minus your expenses. We have multiple brackets in the US for the tax system, and you can also have a state income tax depending on where you live or where you transact business. All depends on the state. I always say 50 states are like 50 different countries when it comes to tax. Self-employment tax, this is what we are going to be discussing today. We're going to touch a little bit on income tax, but mainly we're going to discuss self-employment tax. This is only a federal tax. This is not occurring at the state level. Another tax that happens with small business can be sales tax. Again, 50 states, 50 sets of rules. Sometimes it's only on goods, sometimes it's on goods and services. It all depends. And then business tax is another type of tax you could run into. You can have a business license tax, you can have LLC taxes, business property taxes, all sorts of things. Again, you need to know what's going on in your local area, but that's out of the scope of today's discussion. So today we're going to talk about self-employment tax and estimated payments, because self-employment tax is probably the most misunderstood tax for self-employed people and often creates the most unpleasant surprises. And we're going to talk about how not to get caught off guard. And then we're going to talk about estimated payments, which is the way that self-employed people can prevent having a big bill when tax time comes. So here it is. Here's the form. We're going to talk about this in plain English. I just wanted to give you an idea of what it looks like. We're not going to walk through the form because I know how boring that can be. And that's the job of either your tax professional or your software if you're doing it DIY, excuse me. But this is what it actually looks like. And what is self-employment tax? That is a really big question, and people don't always understand that. And self-employment tax is a combination of US Social Security and Medicare taxes that are different from regular income tax. So the entire Social Security tax is 12.4%, and Medicare is 2.9%. Together, that's 15.3%. Now, when you're an employee and you get a W-2 and a paycheck and a pay stub, your part of Social Security and Medicare are deducted from your pay period, because when you have an employer, you split 50-50 this whole 15.3%. You pay 7.65 and your employer pays 7.65. However, when you're a solopreneur, an independent contractor, filing on what we call a Schedule C, which is tied to your 1040, you are both considered both the employer and the employee. So you're paying the entire 15.3% on your net income. That's why it feels so heavy. So we're going to talk about how do we actually calculate self-employment tax. And are there any questions at this point, Doug, that you're seeing coming up?
No questions yet. If you have a question, please type it into Q&A and we will get right to it. Thank you.
Yeah, because if it's going too fast, let me know. Or if you're getting lost, let me know.
Yeah, no question is too silly. So please ask whatever's on your mind.
Absolutely not. No question, no need. This is, as I mentioned, this is a shame-free environment. Ask your questions. That's what I'm here for. So the first thing is, how do we calculate self-employment tax? And first, what we do is we figure out your net profit from your business, which,
So,
as I
Kristin,
mentioned,
we do have two questions.
Sure. Do you want me to, let me just see what they are.
Yeah, take a look.
Oh, yes, this percentage is for Florida. No, this is the federal. The 15.3% is federal. This is not a state item. This is purely a federal tax. And oh, another question. Yeah, before I get into how we calculate it, I'm going to answer these questions because I think it'll be really helpful. Okay, if an individual has 2 or more LLCs, does he or she pay self-employment tax each or only once? Excellent question. So in that, what ends up happening with that is your net income from all of your LLCs, if they're all solopreneurs or independent contractors, it's all pulled together to figure out how much self-employment tax. So if you had net revenue of 15,000 from one business and you had revenue of 20,000 from the other business, the self-employment tax will be calculated on the complete 35,000 of income. Part of the year I was an employee, in the last 4 months I've been self-employed with no income. How will this, okay. So if you don't have any income from your business, then you're not going to have any self-employment tax because you don't have any income, and you may actually have a loss, which you'll want to file anyway. And that's a really good question also, because sometimes people say my business had a loss, I shouldn't file a tax return. Well, actually you should, because then you may be able to carry those losses forward to another year. It's really important to do that. Does everyone who give you a check need to give you a W-2 before the end of January, or only those who employed you on a regular basis? So, okay, so with regard to anybody who pays you, so W-2 is for employees. A 1099 is for independent contractors. So if you had somebody, you were working as a consultant and they paid you, if they paid you $600 or more, they need to give you a 1099 by the end of January. Now, people ask, well, what if they didn't give me a 1099? Do I have to include that income? Yes. Whether or not somebody gives you a 1099 for what they paid you, you need to include all of your income as income, whether or not anybody 1099s you. So for example, in my tax practice, if somebody pays me less than $600 to do their tax return, I don't say, oh, well, they didn't give me a 1099, I don't have to declare it. No, I count that revenue, but they just didn't have to issue me the form. Confused about net profit minus expenses. Employment tax, no, it is not based on what you're paying yourself. It is based on your actual net profit from your business. What you pay yourself is irrelevant for tax purposes. And what you take out of your business, that is owner's draw. And that is neutral on your tax return. That's what we call a balance sheet item. That is not a tax item. So if your business made $50,000 and you paid yourself $30,000 out of it, you withdrew it from it and took what's called owner's draw, you pay tax on that $50,000 because that was your business's income. File an exemption to file corp and use paychecks. Okay, did we leave anything on the table? Michael, let me answer that one at the end. Doug, if we could keep Michael's question up there and I'll answer that toward the end.
Okay.
Can you count deductible expenses before the day you registered? Yes, because whenever you registered your business is irrelevant for IRS. If the business was taking place and you were just, you haven't created an LLC yet, and you're just running your business, IRS doesn't care. They want to know that you had those expenses and that income. Let's see, a question of calculating expenses for calculating income. Let me just see. Cell phone. That one I can answer and leave Mara's for the end also.
Okay, we'll do.
Yeah, and Mara, the short answer to that one is you count a portion. Actually, it's not in the scope of today, but yes, count a portion, and that you kind of have to wing and figure out, am I using it 80% for business, 20% for personal, 50-50, and then you adjust that accordingly. So yeah, you can close that question, Doug.
Okay.
So, okay, cool. So how do we, you're welcome. Okay, so how do we actually calculate the self-employment tax? The first thing is we figure out your net profit from your business, which we said is your gross income minus your expenses. And that figuring that out, that's outside the scope of the self-employment tax class, but you do need to figure that out. So your net profit minus equals income minus business expenses, cost of goods sold if you have parts in your business that you are buying and then reselling to somebody else, or creating, like if you have stationery, you do stationery and you buy all the supplies and you make the stationery and you send it out. Depreciation, again, that's out of the scope. of this class, but home office when that's applicable. And not to fear, I'm not just talking about this, I'm going to show you an actual physical example of how all of this works, because I know it can get very confusing very quickly. So we take your net profit and we multiply it by 92.35% because we're adjusting for a self-employment tax deduction. And then we take whatever that number is and multiply it by the 15.3%. And now you have how much your self-employment tax is that you're responsible for paying. So let me just go to Mara's question real quick. If I bill someone in December for work completed in December and the check arrives in January, excellent question. When you pay taxes. So as a sole proprietor, as a single member LLC, you are considered a cash basis taxpayer. So it's when that revenue hits your account. So if you bill in December and you get paid in January of 2024, that is 2024 revenue. That does not count for 2023. So prior dominance. Okay, Amanda, I'll take that one at the end. Because that's going to take a little bit longer outside of this. No, tax deductions can be taken. It doesn't matter if you're a sole proprietor or an LLC, because if you're an LLC reporting as a sole proprietor, it all ends up on the Schedule C. Whether you have the LLC or you don't, it doesn't matter for IRS tax purposes. It's the same. So if anybody tries to sell you, by the way, there are very good reasons for having an LLC. But when people sell you, oh, get an LLC and you get even more tax deductions, it's a lie. Because if you're a sole proprietor or you're an LLC, the tax code, well, an LLC functioning as a sole proprietor, as it would also be called a disregarded entity, it doesn't matter. The tax code is the same. So, okay, so we went through how it's actually calculated. Now, let's talk about, that sounds like a lot, and it can be a really big surprise. Because with the standard deduction being so high right now, you can have no income tax, but you could still get clobbered with Social Security tax. And then people are like, well, I didn't make enough to pay tax in my business. Well, you may not have made enough to pay income tax, but you sure made enough to pay Social Security or pay self-employment tax. So you can get really caught out when you weren't expecting it. So what we're going to do is take an example of how this actually works in real life. So to make this really simple, I have Andy, who's a candle maker, and she calculated her income and expenses, and she found for this year she had $25,000 in net income. Now, Andy is single, and she has no dependents, and she rents her apartment. We had to make Andy very, very straightforward because that makes this easier to understand. So her net income is $25,000. Now, remember, we multiply it by the 92.35%. So that gets us to $23,000 and change of self-employment taxable income. Then we multiply that by the 15.3, remember both sides of Social Security and Medicare, and that comes out to her owing $35.53 of self-employment tax. However, oh, my slide's a little cut off on the bottom there, my apologies. But wait, there's more, because we're going to talk, also Andy's going to have income tax as well. So we're going to bring it all together now. So we know that Andy's SE tax on her income is 25,000. Her SE tax is $35.33. Now, by the way, before I get through this whole example, does anybody have any questions on any of this? Are you confused at all? I'm going to take a quick pause for that. Can you declare your taxes independently from your husband? I'll cover that one at the end because that's not right on this one. We'll talk about that at the end. So leave that one up, please, Doug. Okay. So, all right. So we've got Andy's SE tax on her 25,000 and her SE tax is 35.33. But Andy, because she's made more than the standard deduction, she still has earned income tax that she has to pay. And Andy's federal income tax is on this 25,000 is $1,028. How do I know that? I ran it through my tax software. That's how I know that her income tax, which is separate from self-employment tax, is 1,028. So then we take the 3,533 of her self-employment tax and, oh, plus 1208, whoopsie, typo there, sorry about that. It should be 4,561 is the correct total. My apologies, I'll fix that, Doug, my typo, I can't believe it, I thought I cross-checked everything. And with the presentation, the handout slides, we'll get those numbers correct. The total should be 4,561. And that is the correct number. Andy, if she didn't make any estimated payments, she would be stuck with this bill at tax time of $4,500. And instead, Andy worked out with her tax professional and she figured it out ahead of time. So in this situation, let's say you made $25,000 and you didn't pay any estimated taxes through the year because you didn't know, it's your first year in business, you're trying to figure this out. You show up in March, you're going to get hit with a bill for $4,561. And the worry with that is like, oh my gosh, how am I going to come up with that? So this is how we're going to segue into estimated payments. Let's see here. Doug, can you take that question about the slides before we go into the estimated payments from Caroline?
Is there a way to get the slides sent right now? No, the slides will be sent after the presentation. You'll get them later. We can't get them to you now.
Okay, so Caroline, just maybe make your notes based on the title of the slide, and that might be helpful for you so that you can go back, because you're going to have the recording as well. So you can go through to the parts that are that you wanted to revisit at that time. Okay, so as we know, Andy's total federal and SE tax combined is going to be 4,561. Oh, and just going to Amanda, does the 15 count as an expense? No, it does not. It is not a deductible expense. It just is. So there's that. And lives with her parents, just started LLC. Brenda, I'll answer yours at the end. And Doug, I answered Amanda's question. It is not an expense. Okay. All right. So now we have the 4,561. And Andy kind of had a feeling she would make about 25,000 because this is magical land of Andy has a crystal ball and knew she would make 25 grand. So she told her tax professional, and what they did was that they generated quarterly estimated payments for her. So 4,561 divided by 4 and rounded because it's not the perfect number ends up being 1,141 a quarter. So Andy made IRS quarterly payments on the quarterly payment dates. And we're going to talk more about estimated payments in a little bit. So if you're a little confused, don't worry, we're going to get into it. She made the payments on April 15th, June 15th, September 15th, and January 15th of the following year. It's weird how it's organized, but we're going to talk about that. And that totaled 4,564. So Andy, because she paid her tax in chunks throughout the year, she ends up getting $3 back. So essentially breaking even. And that's how that works. Any questions at this point? So if you don't make estimated payments a year, charges penalty. Yes. So I heard another, Mara's question is, I heard in another SCORE webinar that if you don't make estimated payments throughout the year, IRS charges a penalty. Does that mean an extra fee so you pay more if you don't pay throughout the year? And yes. So Mara, I'm going to leave this question up and I'm going to talk about that when we get a little further into estimated payments, but potentially yes. The answer is a lot of times, as in tax, it depends. So leave that one up there, please, Doug, and I'll talk about that. I'll circle back to that one.
Yeah.
So what are these estimated payments? What do they look like? At some point, if you are making a profit in your business, you're going to need to pay IRS something. So we're going to talk about exactly how to do this. So why do we have this system of estimated payments? And the reason is because in the US, we have a system, it's called pay as you go. And the standard joke with tax people is as you get paid, there it goes. So when you're a traditional employee, every time you get paid, Social Security and Medicare and income taxes are automatically deducted from your paycheck. When you're a self-employed person, solopreneurs and independent contractors, you don't receive regular paychecks because you're working with a client, they're paying you in chunks, or you're working with many clients and they pay you bit by bit. And if you had to pay IRS every time you had a $200 job or a $1,000 job, you would be on you'd be on their website all the time making payments, and it's just not feasible. So what IRS does is they have another system, and that is called quarterly estimated payments. And how do you know? Caroline, I'm going to answer that one at the end.
So Jennifer's
Jennifer,
question real quickly. Yes, you can, I would suggest, again, no silly questions. There's no
yep,
silly reason to request a mentor. That's what we're here for. And we certainly can work with you on that. So you can go to our website and you can look at profiles or just ask for a mentor to be assigned to you, and one will, and you'll hear from us and we'll be happy to discuss that with you. Jennifer.
wonderful. Awesome. And then Sherry, if you make quarterly payments and your SE tax is less than, absolutely you get a refund. And what you can do, you can either do one of two things, is you can take that refund and put it in your pocket and move it, on to next year and move on with your life, or you can apply it to next year. That's something that you can also do with your payments if you have, or with your refunds, is you can apply it to the current year and reduce the amount you have to pay out in estimated taxes, because you've already applied from the prior year. So let's talk a little bit more about what these look like and how we actually do it. So when do we make estimated payments? We make them quarterly. And some of them might seem to make sense and some might not date-wise, because you would think that the quarter would close and then you have a couple of weeks and then you make your estimated payment. Well, sometimes it works that way and sometimes it doesn't. It has to do with IRS's fiscal calendar. I remember looking this up once, why it's wonky, but there is an actual logical reason. I just don't remember what it is. Anyway, so for quarter one, you need to make your estimated payments by April 15th to be compliant and not potentially have a penalty for making a late payment. June 15th and September 15th are a little bit odd because you have to make your quarterly payment before you're done with the quarter. So you have to guesstimate what your income is going to be those last 2 weeks of the quarter. That makes it a little tricky. And then January 15th is for quarter four. So for this year, for 2023, your quarter four payment for 2023 is made by January 15th, 2024. And that often confuses people because it's in the next calendar year, but that's actually how it works. And then when I work with clients, I have to make sure that when they tell me they made their January payment, that it's actually the January payment for 2023, not the one for 2022 that they made they made in January of 23. So that January one gets a little tricky. So always remember to put the year along with, oh, I made it January 15th, January 15th, 2024. So let's just see, as a sole proprietor, I will open a bank account. I'll answer that one at the end as well. Okay. So how do you actually make estimated payments? Now, there are three ways. There's the IRS direct pay system, there's a paper check with vouchers, and there's credit card via third-party online payment services. But please, please, please do not cut a check to be mailed directly from your bank to IRS for estimated payments. So, I see this less now. It was more frequent probably about 10 years ago, before online payments really came into their own. But if anyone is still doing this, and I do have clients who still do this, where instead of making an online payment or writing a paper check, they go to their bank and they say, oh, Bank of America, mail a check to ABC company for $750. And the bank prints up the check and mails it out. Do not do that with IRS, because it will get lost. It will end up in a black hole. And then you're going to have to pay somebody like me or another tax person to go undo all of this, and it gets very messy, so just don't do that. Okay, how do you make estimated payments? Option number one is IRS direct pay. This is the easiest and most traceable way to pay. You pay online directly from your bank account. You receive a confirmation number and a receipt, and the payment is traceable if it gets misapplied. Less likely to happen when you pay online, but it does. You can do it as an immediate payment. You can also set it up in advance. I get a little leery of that because if you forget that you set this up in January and you set up a payment for April and you don't have enough money in your account, it's going to bounce and then you're gonna have a different set of problems. So I recommend doing that, setting a reminder for yourself and just making the immediate payment when you have that money in the bank. It's also great for last minute payers because it's April 14th, you're like, oh, I didn't pay it. So you go in, you pay, you're done. And there are no additional fees for doing this because they're debiting it right out of your bank account. An example, one sec, I'm gonna just take a look at Emma's question. It's really to rent of an apartment. This was not, the example income is not related to the rent of the apartment. I was just saying that she was a renter and didn't have a home office just to make it a simpler example. But a renting situation is completely different than the self-employed income. That's a totally different schedule and generally not subject to self-employment tax. Okay, so estimated payments, you're going to go to direct pay. This is how you're going to do it. You just follow the prompts. IRS has actually made it really easy and fairly clear to pay via direct pay. Another option you can do is a paper check with a voucher. Now, sometimes for whatever reason, people have issues with the online system. They can't get verified. Something happened, I don't know, or they're just really adverse to paying online, or they're not comfortable with it, whatever the reason is. Option number two is a paper check with a voucher. And these are what these vouchers look like. And they say estimated tax, payment voucher number one. No, it'll say payment voucher number two. And you see right here, it says calendar year due date, due April 18th. Why was this year due April 18th in 2022? Because April 15th fell on a weekend. And then the 16th, April 15th was, I believe it was a Saturday. The 16th was a Sunday. 17th was Emancipation Day in DC, so that's a federal holiday. And then the 18th becomes the first business day after the 15th. So generally speaking, it is the 15th of April, June, September, and January, but it can change a little bit depending on if the 15th falls on a weekend. So anyhow, so we've got that. Paper check with vouchers. You can either have pre-printed ones or you can use blank write-in vouchers. If you're working with a tax professional, they'll give you usually pre-printed vouchers with your name and possibly the amount of your estimated tax if you worked with them to figure out what that might be. You would pay with a check in your mail. And it generally works, but it can get lost and it can get misapplied by IRS, which is unfortunately more common than you would think. A couple years ago, I spent over 18 months undoing a misapplied estimated payment for a client. Her payment was more in the neighborhood of $3,000. IRS accidentally messed up and applied somebody's $25,000 payment to her account. She, being the good citizen, sent it back and they said, okay, great, we got it back. Now you owe us 25 grand. It was a big mess. And we ended up having to get her senator involved because we could not get resolution with IRS. So this is why I get very, very leery of paying with check unless you absolutely have to. Also, there's less wiggle room for last minute payments. So if you don't get it in on time, they may not timestamp it as coming in by April 15th. So that's why I'm not a big fan of these. So far since June. At this point, I think I'm going to answer all questions at the end because this is a lot of, I think we can get through a lot of them at the end at this point, but keep writing them in and I'll answer them all at the end.
Okay, please type them into Q&A and we'll wait till the end to answer them.
Yep, we'll do that. We'll do them all at the end. Okay, so option three, you can pay by a credit card via third-party service. This is online payments. If you don't have the cash to pay your estimated tax online, and you really want to pay it right now, we're going to talk a little bit about the pros and cons of doing that. There are 3 authorized providers. So ACI, Pay 1040, and Pay USA Tax. If any other if somebody says that they're an authorized provider for estimated payments, they're wrong. It's a scam. Stay away. It's really important because there's a lot of scammy stuff around IRS. So be super, super careful. Watch your websites. Watch the link at the top of your screen when you're going to pay somebody. And again, with IRS Direct Pay, make sure you're on actual IRS Direct Pay. Flip back to this webinar, take a screenshot or take a look at what the site should look like and use that as your guide. If you use this credit card via third-party service, they're going to hit you with a service charge. It's going to be approximately 2%. And the interest rates on your credit card will almost always be higher than IRS's rates. So I proceed with caution here. IRS actually just raised their rates. I think it's closer to 8% now. It used to be around 6%. But with inflation and the prime and all of these sorts of things, they've raised it, but still 8% on owing something to IRS is a lot less expensive than most credit cards these days. So what happens if you can't pay your balance due to IRS? So you've made some estimated payments or you haven't or whatever. What do you do? Technically, you could put some or all of the amount on your credit card, but that's going to open you up to additional fees that we just discussed and a high interest rate. Otherwise, you can apply for an installment agreement with IRS. The cost to set these up is minimal. You do them online, right on their website. Their interest rate is going to be far lower than a credit card, and you have up to 72 months to pay it off. Interest is still going to accrue on this money, but you're going to have a regular payment. And in here, you have the link to the installment agreement option. There are shorter installment agreement timeframes, but this is the most common, so that's why I'm talking about it. So estimated payments, last thoughts. It's easier and it's less stressful to pay quarterly payments throughout the year than owe a lot at tax time. And also you kind of know where you are with things. If you're working with someone and you're looking at your income and your expenses quarterly, you'll have a better idea of how things are going so you don't have surprises. One of the best things you can do for yourself with tax is not have surprises and be strategic, because the more you plan, the better you can make decisions. And one thing that I always tell independent contractors and self-employed folks is to get into a good habit. Every time you get paid, you need to set aside at least 20% in federal of whatever you made for federal and self-employment taxes in a separate savings account, because then when it comes time to make the estimated payments, you're going to have some of the funds. You might not have all of the funds, but at least you'll have something. Now, for those of you in higher tax brackets, obviously this percentage should be higher, but it's at the bare minimum, it gives you something to go on. And when you get paid and you move it over, and then you look at your account on April 15th and you realize you have to make a $5,000 payment, you're like, oh, I don't have it all, but at least I have 3. It's better than nothing. And so even if you can't make that whole estimated payment that you know you're supposed to make, just do the best you can, because every little bit is going to help at tax time. And the more you have paid in, which balances with what you would owe, the closer you get to 0, the less chance you are to have penalty and interest tacked on. And the last thought is really use IRS Direct Pay rather than check or credit card for tracking purposes and for cost purposes. So Q&A time. Let me get through some of these from the beginning. Okay, so to simplify, we have a single member LLC. The IRS to get an exemption to file as corporation. So Michael, you changed your status. You elected to be filing taxes as a corporation instead of a sole proprietor. Use paychecks, okay. So the question to this, the answer is it depends. So I just went over I had this question with someone yesterday. I do individual consults, and we were talking about the whole S Corp conversion, and there are a bunch of reasons to do it or not to do it. And when it comes to S Corp, this is a little bit out of scope, but if anybody in this group has come across online as a sole proprietor, Convert to an S Corp, save tons of money. It depends. So depending on where your revenues are, it may make sense to convert to an S Corp. It may not. They have to be, in my opinion, fairly steady and at a decent amount for a certain number of years. And this is just me, everybody has a different opinion. But if I'm not seeing somebody with a steady net income of 100,000 or more, maybe 80,000, I'm not quick to put somebody in an S Corp. That's just me. And the reason for that, A, is because as you found out, when you convert to an S Corp, now you have to run payroll. And now you have that added expense. You need to also file if you did convert to an S Corp, you're going to be filing an 1120S. So now you have another tax return to prepare. You're going to have to figure out reasonable compensation. There's a lot of pieces that go into it. And it's a decision that you need to make with your tax person and really ask their why for having you convert. Because there are some tax people who will look at it with you, and the ones that I refer out to for S Corps, they'll look at it and say, does this make sense? Because it may or may not. And then there are some tax people who are like, everybody should convert to an S Corp. Well, I don't agree with that. And there are also, quite frankly, there's some tax people who would like to convert everyone to an S Corp because they get to do an extra return and bill an extra fee, even when it's not warranted. And that I have a problem with. That's me personally, again. So maybe it was a good choice. Maybe it wasn't. I don't know, because I don't know your personal situation. But yes, there is more involved when you move from a solo entrepreneur on a Schedule C to moving to a corporate filing status. I own an insurance agency and an LLC, but currently sole proprietor. When you submit W-9, some use your social and others use your EIN. Okay, so Amanda, actually, this is a really good question because I actually have an insurance practice myself, so I know this well. Now, what happens is in the insurance world is that oftentimes a carrier will not issue in your EIN because your insurance license is tied to your social, so they get very sticky on that. And otherwise they say, well, your agency has to be licensed. And as you know, that's a lot more expensive and a lot more time consuming as opposed to you, the agent yourself, being licensed. So technically the correct way to do this is to anything that comes through your EIN goes on a Schedule C. You're on a Schedule C, so actually that's not really a big deal. It's when you have an S Corp tie and you're doing insurance work, you can blend it all together on your Schedule C, because believe it or not, the EIN that you have for your LLC really doesn't have anywhere to go and technically isn't supposed to go on the Schedule C, even though you have it for business purposes. It's a really weird thing, but you can put all of that together. If all you're doing is selling insurance, you can put it all together on that same Schedule C, because that EIN as a sole proprietor is going to feed back into the Schedule C anyway. So can you declare Mara is asking, can I declare my taxes independently from my husband? You could do married filing separate. When you have your own business, it'll be on your own Schedule C anyway as part of a joint filing. Can you file married filing separate so it's all completely separate? Absolutely, you do have the right to do that. However, if you're going to do that, I would strongly suggest working with a tax professional because of the way taxes interplay when you file joint versus separate. There are certain rules that change. Sometimes it can cost more in tax to file separately, but sometimes there are good reasons for it. There are people that I have that are in remarriages and they file separately because the new spouse doesn't want the ex-spouse knowing what they made, so they file separately. For them, it is worth the tax differential. What if Andy lives with her parents and she's 22, just started her LLC this year and hasn't done a sale in her business? Okay, so it has to do with revenues. We actually have, as tax people, I have a worksheet that I run through with my clients that says, is Andy still considered a dependent or not of her parents? We would go through that and see, does she count as a dependent? I'd have to drill down a little bit more into that. The answer on that one is it depends. She may still be considered a dependent. She may not. It depends. I heard in another school, Mara is asking, I heard in another school webinar that if you don't make estimated payments throughout the year, IRS charges a penalty. Does it mean that an extra fee, so you pay more if you don't pay throughout the year? And does that also apply if I have a part-time job and get a W-2 and had tax withheld from that? Excellent question, Mara. And this is gonna be a little bit of a long answer. So everybody strap in here, buckle in. So if you're not paying throughout the year, the short answer is it depends. So if you're not paying throughout the year and your business doesn't have a whole lot of revenue, it may not matter because you have some tax being withheld from your W-2. So it's an it depends question, because some of the tax, if you don't have a lot of self-employment income, but you have a decent amount of W-2 income, you may be able to offset. This is a time, again, where you're really going to want to work with a tax professional who is preparing your taxes to go through and say, let's run a projection and see where you are. How much of this, because I have people who either are, let's say they're married and one person's a W-2, they have W-2 and the other one's self-employed. Depending on how much income that self-employed person has, we can adjust the W-2 withholdings enough to cover the tax for the self-employed person. So you need to work with somebody who's going to be doing that planning throughout the year, as well as preparing your taxes. That's it. It's really important on that. And that's something that the DIY software is not so good at, because the planning needs somebody who's finessing the numbers and figuring out how it's all coming together. So Caroline, how do you know if you need to pay quarterly or just at the end of the tax year? It depends. This is, again, a time where you want to work with a professional because they can help you figure out if you need to pay quarterly. One thing I can tell you, though, is let's say a really good example is a realtor. Let's say you're a realtor and you don't sell any houses for the first 3 quarters of the year because it's tough. And then in Q4, you sell 3. Well, you don't want to pay estimated tax because you didn't make any income. You were probably even backwards because you had fees. So you were in the red for the first 3 quarters. So you're not going to necessarily have to pay estimated tax those first 3 quarters because you didn't make any money. Now in Q4, you're going to want a projection and see how much you're going to owe then. And then your preparer can do a form called a 2210, which allocates your income by quarter. So in case there was a penalty showing up on your return, you can get it mitigated or completely wiped out. Okay, Mara's saying, as a solopreneur, I will open a bank account dedicated to my business expenses and earnings. Excellent, great idea. Keep it out of your personal. Should you provide your EIN or SSN for clarity of IRS payments? Put your EIN on it. It's your business account. Keep it in your EIN. That'll also make it easier if you do eventually decide at some point to convert to an S Corp or a C Corp or whatever. Not saying you should or you shouldn't, but if you do, if the EIN is already on the business bank account, it will be easier for you to do that. Emma's asking, I guess a more direct question would be, how does an individual report money that is paid to their landlord? That you'll want to keep copies of checks. If you're paying your landlord, I would keep all copies and receipts. If you're not paying them by check and you're paying them in cash, have them give you a receipt for the rent that you're paying. You'll want to have some sort of tracking and a check, or if you're doing a Venmo payment or whatever, make sure you're classifying that as a rent payment. Mara's asking, I've been in business as a sole proprietor since June and receiving a few checks since then. Okay, register my non-fictitious name in November. Estimated payments from the previous 2 quarters in January 15th. And you should be making them, excellent question, you should be making them in your social, because that is where it's going to get tied to on your 1040. Your 1040 is going to be tied to your social security number. Make those estimated payments in your social. I know that's really confusing because with an LLC, you'll have an EIN, but make the payments in your social because this is all tied to your 1040, which is your personal tax return. I see the IRS wants you to put your spouse's detail on the estimated tax voucher. Why is that? This is if you are filing jointly. If you don't have a spouse, that line would be left blank. Which tax software would you recommend? For DIY, I don't have a really good answer. I can tell you of the ones that I've seen where clients have come to me from doing DIY, I would probably say the cleanest returns I've seen have come through the H&R Block tax cut software. The other ones, the other big name, which is the 800-pound gorilla in the room, who I will not name, I find their software very unwieldy. I think that they have a lot of hidden fees. So Block's tax cut, I've seen clean returns or cleaner returns come through. Some people like Tax Slayer, but I don't know enough about them to comment on it. How do you calculate the federal taxes? That is, I did that using my tax software because federal taxes they're in buckets. So you have different brackets, so different income. The first X amount of dollars is taxed at 0%. The next bracket is 10%. Then we have 22, 24. This will all change theoretically at the end of 2025. But it gets taxed in buckets. So there's a whole formula to it. If you take a look online, you can see there are calculators for it as well that you can use to figure that out. And also the brackets change depending on if you're single, you're married, filing joint, if you're head of household, if you're married, filing separate, et cetera, et cetera. So the short answer is I let my software calculate that out because of all these moving parts. Okay, Amanda's question is, how are taxes for a VA that works in another country? Excellent question. So if you have, this is really, I've run into this myself. So if you have a VA that you're paying who's out of the country, is never going to step into the US, you actually don't have to file a 1099 for what you're paying them. And Social Security taxes and all of that doesn't really apply. We call that outside services. So when I have clients who are doing that sort of thing, we put it in line, it's outside services, it's outside the country. They're not having, they're just over there. They're going to be responsible for dealing with that in their own country. Okay, so Mars' question is, if at some point I become employed and my employer files my taxes, do I have to file taxes as a sole proprietor? Okay, so your employer does not file your taxes. What your employer is doing is they are giving you a W-2 showing what they paid you. They don't get involved in filing your taxes unless you're maybe working for a tax office and they might do it for you. But you have to file as a sole proprietor, yes. When you're not receiving income for your business, if your business has expenses and you want to be able to preserve those losses and use them either in the current year, or if you cannot, Doug, don't delete that question yet because there are more parts to it. If you have losses, you're going to want to declare because you may use them in the current year or carry them to future years, depending. Do you have to notify the IRS in the state of Florida that you stopped operating as a sole proprietor when it is in standby? No, but if you're kind of putting your business on hiatus, what I would do is still file 0 returns, and you may still have some upkeep expenses for that business. You may still have a website. You may still have little expenses here and there that should belong on that Schedule C. Okay, so Michael is saying we did it purely from a hassle avoidance on my wife's business. We figured with paychecks, we did away with having to calculate pay taxes. They do the lifting. We did an S Corp, so all of our taxes are separate from our own. Okay, yeah, and that's fine. Perfectly sound reason. The only reason I bring that up about the S Corp is because there are a lot of places online that are trying to sell people becoming S Corps without a sound reason for doing it. So that's why I get very passionate about that, if you will, because I've seen that happen, and it upsets me when people get taken. But yours sounds like it makes sense. So awesome. It's working for you. Go with it. Anonymous member has asked, if I've started my business and I've worked for a year and made 130 but never paid taxes, what do I do? Okay, the first thing you're going to want to do is get yourself with a tax person who can run a projection for you so that you can see what your exposure is, because I don't know if that 130 is gross or if it's net after expenses. Because here's the thing, you could gross 130, but if you had 120,000 of expenses, you have $10,000 of taxable income. But if you grossed 130 and you only had 10,000 of expenses, now you're going to have 120 of taxable income. So your best bet is right now is to get yourself with a tax person, get some projections running, work with them to do your taxes going forward so that you don't get caught out going forward. And this way, if you know in December that you're going to have a hefty tax bill in April, this gives you almost just a hair over 4 months to prepare, as opposed to waiting and having a lot of anxiety about it. Or maybe you don't have anxiety. I would have anxiety because that's the way I'm built. But then you find out in the first week of April that you owe all this money and you're like, how am I going to get it? You know, if you know in December that this is going to happen, you've got 4 months to plan for it. And it just brings that anxiety level down. Gautam is asking, does it make sense for an LLC to convert to an S corp for tax purposes when the company, i.e. the LLC, is a non-revenue generating entity for small business acquisition purposes? That I don't know. That's going to be a little bit out of my scope for small business acquisition purposes. That's out of the scope of this discussion. But generally, I would say if you have a non-revenue generating entity and the entity has no revenue, I'm not sure from a tax perspective why that would help you to be an S corp. There may be from a liability standpoint, and that is more a question for an attorney, and that is out of my scope why that would be. So I'm going to punt on that one. If I set up a 6 months owed tax agreement with IRS at 8%, but then I paid off in 2 months, you just have it and you paid off in 2 months. Do I still have to pay the 6 month 8%? No. Once you're done paying them off, you're done. They're not going to charge you interest moving forward. Once you've paid them, and you're free and clear with them. Isn't forming an LLC more of a liability separation for personal tax reasons? Yes, it's more of a liability. It's a couple of things. It's mostly liability. And it also depends on the type of business that you have. Like I always give the example that my stationery people, maybe they want an LLC, maybe they don't, but their liability is probably fairly low. Again, I'm not an attorney, so this is not a legal opinion. Consult your own attorneys. But their liability, maybe they deliver the wedding invitations late, but they're most likely not going to kill anyone or maim anyone with stationery. Now, if we're talking about a landscaper who has big noisy equipment and stuff like that, even if they are a sole proprietor, it might make sense to have an LLC for protection purposes. And also, if you're ever thinking of selling your business down the road, having that LLC makes it a little easier because when you're an independent contractor and you're doing consulting work, trying to sell that client list that way might be more difficult than if you sell a business that's considered a business, has its own name, it's a separate entity. So there are a couple of reasons why you may want to have an LLC. And it also depends on your state and it depends on the rules. Like California, I always tell people, think really long and hard if you're going to form an LLC in California, because their LLC fee compared to Florida is like $130. In California, that LLC fee is $800 a year. It's not cheap. So think about it, why you're doing these things. Brenda's asking, well, I need to pay taxes if I haven't made a sale yet, but my LLC is active. No, if you don't have any sales and you don't have any income, you don't have any tax for that business. I can't speak to the rest of your tax return, but for that business, no. When I say tax professional, does it matter if you just go to a place such as H&R Block, or is it best to hire privately for? Okay, my opinion on this is to find a preparer that, and again, there can be very good people at the chains, the H&R Blocks, the Jackson Hewitts. They can have very good people, but I prefer to work with a firm that you know who the preparer is, you know who they are year over year, they know your story. They do projections, because at the big chains, you may not have that planning capacity. They come in, you give your papers, you go, and that's it. But when you're working with a smaller firm, whether it's a CPA firm, an enrolled agent firm, a firm owned by an enrolled agent or a CPA, you're going to have maybe a little bit more stability and a little bit more guidance. And that's, again, my personal opinion. Amanda's asking, what is the average percentage of sole proprietors should put aside for SE and income taxes, assuming profitable? The answer is it depends, because it depends on how much profit you have because of the different tax brackets. If you want to be, that's why I threw out that 20% number, because it's the SE tax plus a little bit more. But if you're profitable, you really want to be working with a tax professional to see what you should be paying, because it's going to depend on your revenues, and your quarterlies can be wonky. Like if you think about with my work in my tax practice side of my business, my revenues are mostly a little bit of Q1 and mostly Q2 because of the way that it works. And then it's slow, there's some for Q3, and then it picks up at the end of Q4 when I run projections. So you have to know your business, and there's some businesses that are very regular, like the landscape guys, going back to them. They're mowing the lawns every week or every 2 weeks. They know their revenues. If they pick up a new client, it's going to be a little bit more. But if all they're doing is mowing lawns, they're pretty steady as long as people are paying them on time. Amanda asks, I purchased a travel trailer to utilize as an office space on my home's property. The travel trailer is my personal name. Would it be considered an office space? It could be. It very well could be. My business is 1 year old and I made 130K but never paid. Okay, I think Mandy, I think we may have answered this before. We would want to definitely get you with a tax person to work out some projections. Okay, how are federal taxes different than income tax? So federal taxes comprise of the income tax and the self-employment tax. So income tax is one set of calculations, self-employment tax is another set of calculations, and you put them together, that's going to be your overall federal tax. Leanna is asking, how do you explain how to do an owner's draw from a single member LLC? The best way to do this, the cleanest way to do this is you have a business banking account and you have your personal banking account. And when you're doing an owner's draw, you're moving money from your business bank account to your personal account. And that is an owner's draw. And then in the bookkeeping files, it's marked as an owner's draw. So it doesn't count as a deduction because it's not. And it just shows the movement of money out of the business. Yenny's asking, do I need to pay SE tax or extra money aside from my payroll for my S Corp? If everything's running through your S Corp, if your payroll is running through your S Corp, probably not. If all of your income is only through your S Corp. If I'm doing business and residing in Florida, there's no income tax to pay to the state of Florida. If you're a sole proprietor, there is no income tax in the state of Florida. There are potential S Corp, but Florida has very specific carve outs for S Corp taxes. Again, out of the scope of this presentation. Emma's question, does it make a difference if you start your LLC in the middle of the year? No, it does not. No, it does not. So, well, how do we do, Doug?
We've answered 49 questions, Kristin, so that's pretty awesome. We still have time if anybody has any more. I mean, I think Kristin's been firing away, but here's your opportunity. And please type them into Q&A. I know some have typed them into the chat. Move it over to Q&A. And everyone's been very thankful for your presentation, Kristin. So,
we've got some popping up in the chat.
I know I'm going to get a question. If they wanted to reach you, how can they do that?
So they can, and there's a couple that are in the chat. I'll pick those up in a minute. To reach me, you can reach me at hermoneysolutions.com. There is a contact form there. You can also email me, Kristin at hermoneysolutions. I don't know, Doug, can I tell them about the program that I run or no?
Yeah, you can. And if you want to add that to what they get later is fine. So they have a direct way of not having to write it down. It'll be in your slide or something.
Okay, great. So as part of my Her Money Solutions work, I do run a program called Deducted. It's starting again in January 10th. It's 4 lives just like this one. And this is actually part of week 2 or 3, the whole SE tax discussion. So in Deducted, we talk about what are legal deductions. We talk about auto deductions. We talk about self-employment tax. We talk about self-employed health insurance. We talk about home office, what is and isn't a home office. I also talk about self-employed retirement plans. How do you contribute to those? Also, we discuss bookkeeping and what are some best practices around that, so that when you go to a tax person at tax time, you've got your stuff together and you're speaking their language. So that will start in January. I do have an early bird coupon for that, $100 off that course. The coupon code is early bird. Doug, we can send that out afterwards and let people know.
Yeah, they're asking that you please add it to your slides. So when we send it out,
sure.
You want to send me an updated deck, I'll get that to our admin and she'll make sure she sends it out. So they're asking for all this information. Also, let me remind you all that you will get this recording and you will get Kristin's slides probably later this afternoon. Also, the recording will be on our YouTube Minnesota website.
Awesome. Yeah. So with that, I'll put that in there with the Deducted course. The other thing I do is I do consults. Those are for more general questions about formations and in talking about the LLC and different, lots of different stuff. There's a console button on my website, Her Money Solutions, with some questions to ask, giving, prompting people to have some ideas about things that might be bothering them that they've not been able to get answers to. Or if you're working with a tax person and they just haven't had the time to answer, because I will tell you, a lot of tax practices are very full. As of 2019, AICPA did a study where they found that within, was it 5 years, 75%, or 15 years, 75% of CPAs are going to be eligible for retirement, and there's not enough people coming up the ranks. So if you have somebody you're working with, but you need to also get some language around how to communicate with them effectively, I do individual consults. That you can just buy an hour of my time. You don't have to sign up for this big commitment. Just bang out your questions in advance and I'll go through them on the call. Let's just go into I'm going to go into the chat right now, Doug.
Sure.
And answer those because there do appear to have some in there. Edia, sorry if I'm mispronouncing your name. I'm a new interior stylist stager and learned that I should get a tax exempt document, reseller certificate. This is different. Reseller is if you're reselling the furniture and decorations, that would be taxes, but only for the items you're reselling. You wouldn't be tax exempt for your income, but for items that you're purchasing, it's not, you're not exempt from tax, income tax or SE tax. It would be being exempt from sales tax. You could maybe do that. It might be a good idea for you for that. Let's see here. Somebody said, thank you, amazing so much for all this information. Okay, thank you. I'm just trying to see if there are any other questions. Did I hear that you have a 15-minute consult or a buy an hour option? I do a buy an hour option because a lot of times 15 minutes never ends up being 15 minutes, and I could do 15-minute consults all day and I only have so much time in my day. But yes, so yeah, no worries, Neosha. Our service tax is different than sales tax. So are you, Caroline, what kind of service are you speaking of? Just so that I know exactly what your, what kind of service? Dog sitter and walker. Okay. So yes, those are service taxes. So you need to find out with the state of Florida, and I don't know off the top of my head if you need to collect sales taxes for being a dog sitter and a dog walker. Certain service-based industries in Florida are taxable and some aren't. That would be something to go on the Florida sales tax website and see if your business falls under one of those, and then you get a sales tax certificate to collect those sales taxes, because you have to remit those on a totally different basis, and that's outside the scope of this presentation. But that's a separate animal, if you will. No pun intended, seeing you walk dogs.
I think you covered them, Kristin. Great job. And we will we're going to get you the recording and the slides, the information requested. You'll also be receiving a survey. Again, I think Kristin did a great job. So please provide us your evaluation. Also, other topics you would like to see covered. We do these weekly. Again, you can go to our YouTube channel and see a couple years back. We want to remind you of that. Also want to remind you that if you would like to request a mentor, please go to visit score.org/Minnesota. A lot of great information out there as well. So Kristin, great job. Thank you so much. Thanks everybody for joining. Have a great afternoon.
Doug, can I add one more thing?
Yes.
If you liked my style of presentation and you want to learn how to find a tax preparer you can trust, I'm going to be giving that talk in January 3rd.
Great reminder, January 3rd. So sign up for that one. Thanks.
All righty.
Bye.
Thank you.